everyone, I'm Richa and welcome to another episode of Groww Digest. This week's topic is the J-curve of internet companies. Mark Zuckerberg started Facebook out of his hostel room. When most people picture this, they imagine a brand new company that was a runway hit from day one. Not true. Most tech successful startups start at a certain point and they go through an uncertain journey that involves steps that are anything but certain. This concept is very well explained by Howard Love. He calls it the startup J-curve. This journey is divided into 6 parts. The first one, creation. At this stage, the company has nothing but a dream. The founders have an idea. They form a team, usually small, and consisting mostly of the co-founders and the money. Where does the money come from, you ask? The founders most often put in their own money. There are also investors who invest in such companies for a sizable stake of the company. These investors are usually of a particular variety. They are called venture capitalists. They invest in loss-making startups who have the potential to generate massive amounts in the future. This is a very exciting stage because at this point, everything seems possible. Whatever the idea is, it does not exist as a service or a product. It is an idea in the heads of the founders. And mind you, there are many startups who do not receive any investments from investors at this point. The second one, release. This is where several startups release an initial version of their idea out to the world, to whomever they want to target. A very large number of startups get funded at this stage. Think of some very big names. Airbnb, WhatsApp, Facebook. They all had their releases first and then came the funding. But that doesn't mean that their product was a grand success upon its launch. Quite often the case is the opposite. But at this stage, you get a glimpse or an idea into what the team is capable of, what it can possibly do. This is what baffles a lot of people who aren't in the industry. Why invest in something that doesn't work? Because being early to a possibly successful tech business has massive benefits. And to gain these benefits, the investors are willing to take giant bets. The third one, Morph. For many startups, things start to get a bit dark from here. After their idea is converted into a product or service and is released, the team actually learns about how it fares in the real world. Almost always, the initial version never works. It requires changes. If they are lucky, the changes are small. Most often, the changes are large. The funny thing is, many startups change so drastically at this stage, it is unbelievable when you compare their final version to their initial version. Facebook started off as a social network for colleges. Myntra started off as a custom t-shirt printing company. Zomato started off as a restaurant's menu and contact book. They changed in between. Some changed multiple times before arriving at their final version. The fourth one, business model. Even if a product works, how will the company make money? To many who aren't exposed to the industry, the idea that a company was started without a business model in mind is absolutely dumb. But this is how things work in the modern tech domain. You get the audience's attention first. Everything else can be worked out later. Let's go back to the example of Facebook. How does it make money? It was free till this stage. It still is. But then it wasn't making money. Through various tests and experiments, they figured that the best way to make money for them was to have ads on their platform. The fifth one, scale. This is where the magic truly starts. If a company played its cards right, things should start working now. That is where scale comes in. Something that was alien to most companies in the pre-internet era. When any other business wants to start, the founder will hire people. So will a tech company. When any other business wants to expand, they will have to hire a lot more people. A tech startup might not have to hire anyone or might hire only a few. Imagine McDonald's. If it wants to expand all over the world, it will take so much effort. Find real estate, find suppliers, hire employees, etc. Facebook had the same number of employees working there when they had 1,000 users and 10,000 users. And they went on to hire a few more when they went on to have millions of users. This is exactly why tech companies are so different. This is why investors are willing to invest millions of dollars in loss-making startups. It is so that they can focus on building their product without worrying about paying salaries. And I know to the outside it seems a bit hopeless. There is a company that doesn't have a business model, that doesn't even have a fully functional product, and it is eating money every day. And this view does make sense, because there are several companies from here that do not make it since their product did not work. But the companies that make it from here make it so big that the returns are astronomical. The venture capitalists that invest in several money-eating startups, usually a few successful investments, are sufficient to make up for their investments in failed startups while also making them astronomical returns. This is why investors are willing to invest millions of dollars in loss-making startups. It is so that they can focus on building their product without worrying about paying salaries. And I know to the outside it seems a bit hopeless. There is a company that doesn't have a business model, that doesn't even have a fully functional product, and it is eating money every day. And this view does make sense, because there are several companies from here that do not make it since their product did not work. But the companies that make it from here make it so big that the returns are astronomical. The venture capitalists that invest in several money-eating startups, usually a few successful investments, are sufficient to make up for their investments in failed startups while also making them astronomical returns. The sixth one, Harvest. The company has become more of what people think of a company at this stage. They are making money, they have established patterns and methods, everything looks good. This is when many decide to go for an IPO. And that brings us to the end of the J-curve. Except things get a lot more complicated than this, of course. A company needs money to run, and the money that they raise from investors eventually runs out. So they have two choices, either to start making profits or to raise more funds. An IPO is a way to raise funds for the company. So many companies move the IPO to an earlier stage in the J-curve, and they don't necessarily wait till this stage. When Amazon IPO'd, it IPO'd at this stage. So did several other companies like Uber and Zomato. Remember three important things about the J-curve. Number one, most companies go down before they go up. Number two, most companies are trying to raise money through this entire J-curve. And number three, companies can fail or succeed at any point in the J-curve. So that's all for today's video. Do you have any such interesting stories you would like us to share in our future episodes? Let us know in the comment section. This video is a part of Groww Digest that is shared with every Groww user over email. If you would like to subscribe to the digest, visit the link in the description, or you can also read it at groww.in/digest. There is also a feedback form link attached in the description. Please fill it and let us know what you thought about this video. We hope that you liked this video and it was new and interesting for you. Do subscribe to Groww's YouTube channel for more such interesting videos and market updates.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.